Hi, my name is Aman and I'm a CPA practicing in the Metro Vancouver region of British Columbia, Canada. In this video, I will discuss how to withdraw funds from your corporation using a capital dividend account on a tax-free basis. The capital dividend account tracks the non-taxable portion of various items including capital gains. So currently, as I'm recording this video on 6th of November 2020, capital gains in Canada in 2020 are taxable at 50%. Now I have heard that there are some speculation that the inclusion rate might increase in the future, but as of now it stands at 50%. So that means that if you have $100 of capital gains in the corporation, $50 goes into this notional account. This account is not real. It's only a pretend account called the capital dividend account. Now you might ask, why is it called a notional account? Well, it's because this capital dividend account or CDA does not appear on the balance sheet. Occasionally it is mentioned in the notes of the financial statement, but nothing more than that. However, please remember that this account is tracked by the Canada Revenue Agency, that is CRA, based on information filed on the corporation's T2 income tax return. So the CDA allows you to then pay out $50 capital dividend to yourself in shareholder's capacity on a tax-free basis. You see, many components or pools aggregate together to form the corporation CDA. For most corporations, the key pools include and tend to be derived from: number one, net capital gains realized by a corporation over time. It's also called the NCG pool. Number second, dividends from other entities. And number third, insurance proceeds, which are also called the insurance pool. As with all the CDA pools, the calculation of the net capital gain pool or NCG pool is determined on a cumulative basis since 1971 or incorporation, whichever is later. The NCG pool is determined by adding the non-taxable portion, currently 50% of capital gains, to the NCG pool and subtracting the non-taxable portion, currently 50% of corporate capital losses, from the NCG pool. Even though realizing capital losses will not create a tax liability, doing so will reduce the NCG pool balance, which will impair and possibly eliminate the ability to pay tax-free capital dividends out of the NCG pool. Let me explain with the help of an example. Let's say you hold Amazon stock, which has done well over the past 2 to 3 years, and also Air Canada stock. Let's say you bought the Air Canada stock pre-pandemic. So if you were going to sell both of these stocks, you would realize a gain for Amazon and a loss for Air Canada, and that will result in a net tally with your corporate dividend account. But remember that you can only pay yourself from the CDA net capital gain pool only if it has a positive balance. So in other words, you can have a few bad eggs that may prevent you from issuing a dividend. So one of the tax planning ideas for this year is that you should do some tax loss planning before the end of the year to crystallize the losses. You might want to crystallize any gains first, or at least pay out the balance of your capital dividend account a day before you realize those losses, because those losses will reduce your capital dividend account balance. However, the negative NCG pool balance does not necessarily restrict your corporation's ability to declare a CDA dividend. This is because each CDA pool is calculated and tracked separately from each other CDA pool. When aggregating the CDA pools, any particular CDA pool in a negative balance is treated as having a zero balance. As this concept is complex, let me explain with the help of an example using the fact for Mr. Mark, who is a controlling shareholder of ABC Investments Inc. Let's assume that ABC Investment Inc. and investment advisor of ABC and liquidated all of the securities in loss position, realizing $1 million in capital losses. ABC Investment Inc.'s NCG pool would be calculated at 50% of the realized capital losses, or a negative $500,000. Let's say ABC Investment Inc. also owns a life insurance policy worth $800,000, which matured. The full $800,000 of life insurance proceeds get added to the capital dividend account's insurance pool. In this case, because the net capital gain pool balance, which would otherwise be negative $500,000, is deemed to be nil. The aggregate of the corporation's CDA pools will be $800,000. Consequently, based on ABC Investment Inc.'s facts, it would have an available CDA balance of out of which it can distribute dividends of $800,000. Please remember that you cannot just simply withdraw the funds from the capital dividend account as a shareholder and be done with it. You have to follow certain tax and legal steps in order to make this possible. From the legal perspective, it starts with the passing of the corporation's legal resolution to get certified by an officer of the corporation to make the capital dividend paid or payable. And once you have done that and have that certificate, a calculation would then be prepared for the amount of the CDA in a particular corporation's immediately before the CDA dividend declaration. It would be sent attached to this resolution along with form T2054E, so they all go in together and get sent to the CRA so that the CRA can recognize the CDA dividend. But the real document that is key from a legal point of view is the director's resolution, which sets the capital dividend account in motion. Watch out, the CDA balance must be correctly calculated. Talk to your chartered professional accountant or a qualified professional advisor who can provide the correct amount of capital dividend account to you. The penalty on paying excessive CDA dividend, also known as Part 3 tax, is equal to 60% of the excess dividend. For example, if your CDA balance was $100,000 and you declared a CDA dividend of $120,000, the penalty would be $12,000, that is $20,000 excess multiplied by 60%. You see, for certain gifts such as donation of certain listed securities to a qualified donee, the capital gains taxable amount is deemed to be zero. Thus, the full amount of the capital gain is non-taxable, so it is added to the CDA balance, which can then be paid out on a tax-free basis to the shareholder. You must file an election on the date on which the dividend is paid or becomes payable, whichever is earlier. Note that this date is chosen by you as the taxpayer. Failure to file by the due date will result in a penalty, so it is best to submit the forms before the due date. Having a capital dividend balance that may be parked in the company from previous years can be a great bonus if you are looking to withdraw funds on a tax-free basis. Given the administration involved, it might make sense to do this when enough funds have accumulated in the CDA account. If you want to be notified about our new tax updates, please consider subscribing to our channel. Thanks for watching and see you in my next video. Until then, bye.